When we talk about growing a business, there's one metric that plays a massive role in planning effectively: customer acquisition cost, or CAC. If you're not familiar with it, CAC is the amount of money your business spends to acquire a single customer. This includes everything from marketing campaigns to sales team efforts. But CAC isn't just about understanding your expenses. It's a tool that can guide crucial strategic decisions and help you communicate with investors. Let's dive into how CAC informs two important areas: scaling decisions and investor communication. Imagine your business is doing well and you're considering expanding your reach. Maybe you want to spend more on marketing or hire additional sales staff to bring in more customers. But before you start investing heavily, you need to ask, will scaling actually be profitable? This is where CAC becomes a vital tool. To determine if scaling is smart, CAC works closely with customer lifetime value, CLTV. CLTV measures the total revenue a customer generates during their relationship with your business. The CLTV to CAC ratio is key, ideally around 3 to 1. This means for every dollar spent on acquiring a customer, you should earn $3 in return. If the ratio is higher than 3 to 1, your returns are excellent. But if it drops to 1:1, it signals trouble, as acquisition costs are consuming most of the revenue. For example, if your CAC is $50 and your CLTV is $200, the 4 to 1 ratio suggests scaling is a good idea. However, if CAC rises to $150 while CLTV remains $200, the 1.3 to 1 ratio indicates scaling might not be financially wise. Another important step is to analyze CAC by marketing channel. Not all channels are equally efficient. For example, let's say your email marketing campaigns have a CAC of $30, while paid social media ads cost you $70 per customer. By focusing more on email marketing, you could lower your overall CAC and increase profitability. This kind of analysis helps you scale smartly, putting your resources into the most effective strategies instead of spending blindly. Now let's move to a different perspective, using CAC to communicate with investors. If you're looking for funding or trying to show stakeholders that your business is on a growth path, CAC becomes a critical talking point. Why is CAC so important to investors? Because it shows how efficiently your business is using resources to grow. A low CAC indicates that your marketing and sales efforts are well optimized, meaning you're spending less to bring in each customer. For investors, this is a strong signal that your business has the potential for long-term profitability. But CAC doesn't stand alone. It works best when combined with the CLTV metric. Showing a healthy CLTV to CAC ratio, again, aiming for around 3 to 1, demonstrates that not only are you acquiring customers cost-effectively, but you're also generating significant value from those customers over time. For example, imagine you're presenting to potential investors. You explain that your CAC has decreased from $80 to $50 over the past year, while your CLTV has increased from $150 to $200. This paints a clear picture. Your business is improving efficiency while driving more value from each customer. That's the kind of growth story investors love to hear. Another way CAC can support investor confidence is by showing scalability. Let's say you've identified that certain marketing channels, like email or content marketing, deliver new customers at a low CAC. This suggests that with more funding, you can scale these efforts while maintaining profitability. Finally, CAC data can help you justify new initiatives, like entering a new market or launching a new product line. For example, if your CAC analysis shows that acquiring customers in a neighboring region is cost-effective, it can serve as evidence for why expanding geographically is a good idea. In summary, CAC isn't just about tracking costs, it's a key tool for strategic growth. By analyzing CAC alongside CLTV, you can decide whether scaling efforts are profitable and sustainable. Additionally, CAC helps you communicate your business's efficiency and potential to investors, showing that your strategies are cost-effective and growth-oriented. Understanding CAC equips you with a roadmap for success, whether you're planning your next big move or securing investor confidence.